Thank you for joining us for the October edition of the monthly conference call. Lots going on this month. As we enter the final quarter, the stock market's been up roughly 20% on the year, and it's pretty strong. It's hard to argue. So lots of things in the background going on that are changing. We've still got COVID surging in different parts of the world. In Canada, we're trying to get it under control. I'm in Alberta, which is having one of the worst bouts recently here with our ICU beds filling up. So we're all still dealing with that. I think the second component of this period here is the stock market's been on a run for 18 months. And so eventually big markets roll over, make a top and pull back. And we're literally sitting on the edge of whether or not we pull back or we bounce out of here again. From my charting data today, it looks like we're going to bounce out of here again, which would be great. So Dwight and I have a couple of things all set up to share with you. It's going to be a really interesting quarter. I'm really hesitant to recommend the technology sector just because the charts seem to be changing meaningfully, and I'm really encouraged to recommend the value area or cyclicals area, the energies and the financials and that type of thing. So we've got ourselves a real horse race here, because if I'm wrong, obviously I'm on the wrong side of the trade, but everything looks to me like it's getting set up for a big run higher in energy, and we're going to cover that off today. So let me jump into the charts. What I want to suggest, first of all, is that we've got an energy crisis and it's on us. A recent example is in California, they think they're going to be 5,500 megawatts short of power for 2021, and yet they've recently brought on 4 natural gas generators to bring up 120 megawatts of power. That's still literally, if they did that, if they did 10x of that, so 44 units, they'd be getting close to what they need, and that would just get you back to how much their shortfall is. And each year they've been having trouble, so that's a problem. China is telling manufacturers to lock in as much energy as possible. So they're seeing it on the coal side. They're seeing it on the natural gas side. Natural gas in Asia and Europe is 4x of what it is in the US. So I'm expecting the US markets to continue to roar higher for a while, as long as we have LNG terminals taking natural gas out of here. So I think the US and Canada inventories will remain tight. We also see that gasoline prices are starting to rise. And so what the US government did to combat that in the past was they allowed corn to be used for ethanol and ethanol to go into the fuel. And what that did was raise food prices, because it took corn out of the market and put pressure on the other parts of the market. Everything's got a problem or a cause and effect. So one thing that we're seeing here is the ag trade is setting up. We're starting to see the potash names start to break out. Some of the ETFs, Moo and Cow and those types of ETF are looking pretty bullish. When we go through the commodity charts on the weekly newsletter, look specifically at what's going on in cocoa and coffee and that kind of stuff. It's raging. And corn to me looks like, on a big monthly chart, long-term chart, it's on a big bull flag, and it looks like it's ready to pop to the upside. And I think if we put corn into the gasoline system, we're going to add food inflation here, and I think that's going to add a lot of pressure. Brazil has a couple of problems. They've had a drought, and with that drought has lowered their water levels, so it's hard for ships to get in and out of their harbors. And with that going on, the problem we have is they're having trouble exporting food to the rest of the world, Russia included. And so with that, you have this situation where some of the food is landlocked and not moving around, where we would normally have grains moving around. Western Canada had relatively significant heat wave this summer, and the crops were quite dry. So they didn't get hailed out, but a lot of them got drought characteristics. So we don't have kind of the euphoric levels of grain that we would expect. So that might start to turn up. Anyway, so with that, I think we're starting to see a commodities push in the ag side. And that's a big thing, because if the world doesn't have enough food, that's a problem. And obviously it takes a lot of energy to make food. So if we're having an energy crisis, that creates a bigger problem. I'm using the word crisis, and some people would say that I'm overemphasizing the problem. But I think the bigger issue is natural gas is under in current inventory storage. Crude oil, gasoline, and heating oil are all right at the lower edge of their 5-year range. Now, typically in this period, we would actually be building in the reservoirs or building in our inventory. So if that's going to happen, that would be bullish. But what we start to see is, as the winter comes forward, is that the weather will cause demand, and that rolls our inventories back down. From October to December, on almost all of the charts, we see an inventory build typically at this time of year. So even though the inventory is building, if it stays very close to the bottom end of the range, I think you'll still find prices tightening. With crude oil, we have a whole bunch of things where some of the OPEC members aren't even supplying enough crude oil to get their products to market. So if they had permission to ship 500,000 barrels a day or 1 million barrels a day, they're coming up short on that. And we have 11 countries coming up short in the OPEC group. So if they don't have enough now, that's a real problem. And one of the podcasts I listened to, I think it was with Josh Young, he was pointing out that what you see from Saudi Arabia is they'll say they have enough oil for everybody. And then all of a sudden, as demand starts to pick up, they're actually sucking out of inventory quite meaningfully. One of these days, we don't think that we'll have the power to turn that off. So I think the bigger issue, let me just fix this here. I think the bigger issue that we've got going on here is that around the world, we don't have enough power. So Texas ran out this summer. California is under extreme conditions. New York has had I'll call it the Atlantic coast has had a lot of power issues over the years. Europe's in particularly dire straits between the UK on gasoline and the UK on power. Germany's a big solar output, but the problem is that they just don't have enough. So they're trying to turn back on coal. India's turning on coal. China's turning on coal, all to try and get power in the midst of COP26, which is the meeting to try and arrange for people to lower their climate intensity or their carbon intensity. And so while they're calling for stopping funding fossil fuels and all that kind of stuff, we're literally rolling into this roadblock where we aren't making enough power through alternative energy, and we haven't figured out how to store it enough, so we're not building enough. And when you add all of that together, you end up having this situation where we don't have enough alternative fuel, and yet you're telling everybody to cut you're telling all the producers to stop making fossil fuel based energy. So I think we're getting into a really big battle here, and it's going to be interesting to see how it works out. My main thesis out of this is that you want to buy energy. Nuclear looks ready to explode higher. Natural gas is already rocketing up. Crude oil looks to me like it's just literally breaking out this week. So as those charts break out, I think we're going to see that climb. If corn breaks out, I think corn could break out both on food side as well as on ethanol. So when you see these all of these things start to happen as a package, we're really starting to push into that. Dwight's got a lot of stuff set up on crypto, so I'm not going to talk a lot about it, but the crypto charts are all sitting here. There's a big main trend line for Bitcoin. I don't think Bitcoin's going to end up being the big player in the space, but right for now, it's like the Dow Jones Industrial Average. We all look to it, and yet the S&P and the NASDAQ are kind of where the real action is. So I think we're going to have something there. I want to say that silver put in a new 52-week low for one day and is trying to bounce out of there. Now, we're about to find out if that breaks down or if it actually breaks out. And so if we literally had a sell-off to get rid of all the weak holders and everybody's gone, anybody who's still holding in that space today is probably ready for a rally, and they're probably not selling anytime soon. So I think that could be another place. So for themes for the next month, I've been mentioning it for I think 2 weeks now. Gambling, travel, and leisure and hotels are all starting to pick up. That's a big one. Starting to see improvements in recreational services. I think that goes with travel and leisure. The autos, auto parts, and tires all start to look like they're breaking out. Tesla keeps trying to break out, but it's the wimpiest breakout I've ever seen. Ford and GM, Toyota, Honda, they're all starting to turn up. BMW, Daimler. So I think the autos have a big move coming here ahead of us, and that could be a big one. Up above on the gambling, travel, and leisure, I mentioned travel and leisure, but didn't say anything really specifically about the airlines. They're turning up right now. Now, they've got a headwind of energy costs coming at them, but it could be that they've locked in everything so that they're okay. If travel is going to start to take off and it's autos and airlines, that's more on the personal side and more on the, I'll call it industry side, but not as much on the trucking and rails. Rails put in a nice move on Friday, suggesting perhaps we've got a bottom there and we could start building out of here. I want to say energy. Just the refiners look like they're going to start to turn up. The exploration and production, the solar, all of those look ready to go. Just try to make sure you've got some exposure there. I think that could be very profitable, and I don't think it's a short term. Goldman Sachs is saying this is moving from a cyclical trade to a structural long-term trade. Everybody's tried to cut back on carbon, and yet we haven't built up the solar infrastructure to really carry the load. Pipelines are starting to turn up here. Enbridge looks ready to break out. Kinder Morgan looks pretty good. Heavy construction, Dwight's been posting charts from North American. NOA is the ticker symbol. So that whole space looks good. Life insurance and financials, if the yields are going higher, we should see life insurance and financials probably respond to that. The ag sector looks ready to move meaningfully. And once again, let me remind you on energy. That's how I'm viewing it. It's really the energy sector is setting up here for a massive load, and Dwight has done a great job of managing all of that. So I want to talk specifically about getting lined up in this commodity space. We have, if we go look at, I'm just trying to find my chart list. Where did it go? Let me just go get it. One thing that I think is important here as we go is I'm going to just scroll right down to the commodities and just roll through them. I'm going to turn over the microphone to Dwight at the bottom of the hour so that he can kind of go through that. But the main point I want to make is we're sitting here on the edge of all of these commodities breaking out. And as that happens, this is a pretty important place to think about it. So here's the big picture on commodities. This goes back to the 2011 highs, and we ended up breaking out in September when we're just starting to move here in early October. even as the US dollar has been climbing for months, look what commodities have done. They have been unrestrained. They continue to work higher and higher. And if we just roll out this map till go back into the 80s, what you see here is we had a long period where we had congestion in around this 225, 250 level. We're breaking this downtrend right now. To me, it looks like this whole thing explodes higher. What that doesn't match with is the big move up in a US dollar. So if the US dollar just stays range bound, I think commodities can go meaningfully higher. If the US dollar breaks down, I think commodities can go meaningfully higher. It's just if the US dollar started to explode, it would be difficult for commodities to make that meaningful move. Anyway, I think the way we've set it up right now in terms of our energy transition strategy, we haven't been strong enough on trying to actually build out the structure. So I call it the law policy in la land, where we're not willing to invest in copper and lithium and all that kind of stuff and get those mines going to get the clean energy systems built up so that we can transfer over. So as long as we're going to sit here and just pretend that we don't need more copper and more storage systems and transmission lines and that type of structure, I just think we're fooling ourselves, and we're going to create an energy shortage, not a big bull market for utilities here. So when we see this CRB, look at this uptrend. It's just so strong. Look what it did this week. Surged up nicely, 2.5%. This is just meaningful stuff breaking out. When you look at DDC, this is the commodity ETF, and it's been tracking sideways for 4 months. We've literally just started this week to break out. So you're not late to the party. Look at the volume on Friday, came in at 9 million shares. That's just bullish. There's no other way to say it. This looks ready to go. Look at what the outperformance compared to the S&P 500 is. I think we're on our way to a structurally big move in energy. So looking at West Texas crude, it's taking out the highs that we had from back in June, July. And these are the 2018 highs. We're going through those. Here's natural gas looking quite ballistic. Just, I think we're going to end up in a structural situation here for natural gas. And the problem is that we're going to export everything we possibly can on an LNG tanker. And it's not as easy as crude oil. We don't have as many tankers available, but that's going to keep the US and Canadian market relatively tight for nat gas. Look at heating oil here. It's breaking out to new 3-year highs. It's got 1 cent to go to take out the 2018 highs. That's going to put us at 6-year highs for diesel fuel. Looking at gasoline here, it pulled back. It's back above its 10-week moving average, confirming the move up in crude oil. It's breaking above the 220 level, which was the highs of 2018. We're at 225. This thing looks set to pop. I think all of this starts to run big. So fossil fuel stuff really starting to make a move. Here's corn, and what you can't see on this chart, I should go get it. This is the other chart I have. You can see this is the trend for corn. This is the Tecrium Corn Fund, but you could just see, let me go to the dollar sign version of this because it's a little bit more important. What I want you to see is that corn looks like this is a bull flag, and this is literally set to just shoot higher. And when this shoots higher, both from ethanol and from food, I think we're going to have a really big, robust move in corn, and that should set up well for potash, nitrogen, all that type of fertilizer for grains and stuff. So I'm really watching that area closely. I think that could be one of the biggest movers out there. When we look at soybeans, it's just sitting on a trend line, kind of a bull flag here as well, but wheat looks like it wants to break out to the upside. I expect if corn breaks, all of a sudden we'll see soybean rocket as well. Gold and silver, again, silver closed or made a new 52-week low and then turned and reversed higher on Thursday, Friday. Gold is sitting here right at this similar area. It's just stuck. It's not my best trade right now, but we look like we made a 1-year low in silver. Anybody who wanted to get out probably got out on that new 52-week lows. And if it starts to turn higher, at least be aware that that might set up. It's not my favorite trade by any stretch. Here's copper with a big uptrend being tested this week. Again, if we're going to get into this renewable energy, we're going to have to buy copper at whatever the price. We're going to have to start moving on it. And again, if we're going to have an energy shortage, then we don't have the met coal for smelting it. We're going to have to go to natural gas or something. So again, all of this energy just gets placed into a tight sphere. Here's the livestock index. It's been trailing off lately, but we're apparently having some issues with hogs where we might have more culling to do due to disease. So if that's the case, that's probably going to put pressure on this chart, but it's only 1% of the chart. So here's sugar. This thing, look at this road higher. We had a brief pullback in March, April, and it's just been working its way higher. Look at coffee. This is going ballistic. What's not to like? Here's cocoa and cotton really pushing higher. I don't have anything to say about it other than this is like a big 3-year pennant breaking out to the upside. How bullish is that? Here's cotton. Look at it explode this week. So all these ag areas are literally starting to break out. Canola is moving really high. Medical marijuana, nobody cares. It's literally can't find a heartbeat out there. So that's a real different one. When I look at lithium and rare earth metals, you can see that this chart's starting to crack a bit. Rare earth metals rolled over a little bit. I still don't want to get too negative on this particular space, because I think if the governments are going to get serious about moving off carbon, they're going to have to step on the gas pedal on this side of the fence in a big way. And if you look at Lithium Americas or Standard Lithium or Albemarle, any of those charts, they all look robust. And so I would be waiting for those charts to work through. I should just give us more viewing room here. So anyway, that's one area. When we get down here, here's the total commodity index. And what do you see here? This is breaking out to new 3-year highs. And it's got one more push up like we had this week, and it would probably take out 2018. If commodities are at 7-year highs, do you want to be on the bandwagon? I think you do. I think this is literally just getting started. Baltic Dry Index, look at the cost for shipping stuff around the world. It's just soaring. So no hesitation here. This was, whatever, call it, $1,700 around the beginning of the year. We're over 5,000, so a triple on shipping costs. So that's a big one. I don't want to go through all of these because I cover them off in the weekly newsletter, but here's frac. It broke out up 7% this week, took out the highs in here, took out the highs of 2019. This looks really ready to go now. One of my friends keeps posting a long-term chart, and we have a company in Canada called Meg Energy, and they're just a small oil company, but I'll call it it's one of the more debt-laden oil producers in Canada. But the real trick on this chart is not what we see here. We're up near 5-year highs, but look at this chart over 20 years. And this is the type of change we're in for here. This is $10. This was $55. And if we're just breaking out, there's lots of room to the upside on something like this. We're seeing companies like ConocoPhillips absolutely breaking out to the upside. Here was $72 back in 2018. We're at $70.10. Are we going through that high? Probably this week. This is just getting set up. All of these charts are starting to break out into long-term bull markets. I don't think you want to be short. Here's SLB, the Schlumberger, the oil field service company. What you see here is a big downtrend that got broken. It went up, pulled back to that same level of the breakout tested, and it's just starting to break out this week. I mean, this looks so bullish. It's just hard to sit here. So I'm pretty excited about all of these names. When we go to uranium, and the reason I say uranium is we're going to need power, and we're going to need a lot of it. Germany has a couple of nuclear power plants they never turned on. We'll see how cold it gets there before people start to say, okay, we'll take the nuclear power. There's a big uptrend line on this Cameco chart. It literally came down to the 10-week this past week, turned around and reversed. I have bought some of this. We'll see if I can hold it up. I've just been getting caught in this shakeout here. I think 2 or 3 times this year. It's just amazing. Anyway, I went back into Cameco this week. I don't think it matters where you are on the energy sphere, we're going there. So just try to keep that in mind, that the big picture is up. And if, take a smaller position if you're worried about getting, short-term losses, but then be set up so that if these things really start to go, like, look at what Cameco did in 03 to 07 when commodities were on fire. I mean, this was a $2 stock to a $30 stock. I just think that opportunity is sitting in front of us once again. So everybody's trying to get this figured out. But I think whether you're in the oil side, the nuclear side, the oil services side, all of this is just ready to go higher. Crude oil, just here's a weekly chart, but the big picture is, we're trying to push through these prior highs and the 2018 highs. It's difficult. It always is. As you go through a prior high, the market jostles around here. I think the backdrop is so bullish, just with the tightness in natural gas. And what happens is when you don't have electrical power, then you go to diesel fuel in your generator. So most of the high-rise buildings around the world have diesel for a backup power system, and they'll fire up the generator, and that'll supply power to the building. Well, guess what? That comes from crude oil. So all of a sudden, we're going to have this heating oil demand. While heating oil is in demand, we're now going to move over and we're going to start having these buildings running on the diesel because they can't afford the electrical power. And you don't actually want to own the utilities here. And the reason I think is that as power prices soar and utilities have to apply for increases in their power rates to customers, they can't move up their billing levels fast enough to accommodate the change in their input costs. So in Texas, some people were getting bills. I heard rumors of $15,000 during that price spike. If we're about to go through a price spike on electric power, so just to give you a number, Western US is expected to be 14% less hydro output this year in terms of megawatts because of low water levels. So you have a 14% gap. That's got to be filled by something. So they've, California's touched it with like 4 power plants. They need, 400 power plants, whatever. They need a dramatic change in what they've done. It's not 400, but it's a lot more power plants. I think each plant is good for 30 megawatts, so they need at least 200 to really kind of buffer themselves. Anyway, we're going to move to diesel in all of the big downtown buildings. If that's going on, then that's going to push up diesel prices, which are going to push up gasoline prices as an alternative fuel, which are going to push up crude prices for refinery feedstock. I think this whole thing's set up to go higher. And there's been some talk about the break of the multi-year trend line, whatever. Let's just go 20 years on crude oil, and I'll just put it on monthly. Whoops, quarterly would work too. The big thing that we're seeing here, obviously, is this downtrend line has broken, and we're testing this 76.90, 76.98 was hit in September. So if we break out right here, right now, we're on our way. And I think the ramp we saw in 2003 to 2006 is underway, but we might be in a more explosive environment than that, because we've literally pushed out investment from the energy sector. And so we used to be, energy used to be 12% of the S&P 500. It's only 3%, might be moved up to 4 or something now, but it's literally abysmal what it is. So I'm just going to draw a line here. So this is the breakout we're talking about. It happened in January. We broke out, then we consolidated in here as we try to go through 2018 highs. And then my expectation is that we literally break out to the upside with all of these power shortages worldwide. If I'm wrong, I don't think we've got a big downside risk, just because OPEC is getting relatively tight. Like I said, a lot of the countries can't produce enough oil. And governments are trying to put pressure so companies can't, banks can't lend into the carbon fossil fuel companies. So with that as a hurdle, then nobody can get money to build out this stuff. I think we're racing towards this conundrum, and how it works out, I don't have a good answer for. But we have Mark Carney was governor of England, Central Bank of England. He works for a company that's been buying oil pipelines, yet he's suggesting that we got to get away from oil and gas. Well, why would you buy oil pipelines if you want to get away from oil and gas? To me, it's just like the biggest fork in his tongue that he can possibly have. We're sitting here saying, my company that I work for, and he's a senior director of, is buying oil and gas pipelines, but yet they don't want the world to invest in oil and gas. It just seems crazy to me. So all of that to say, I think this is an explosive situation that goes higher. We want to be ready for that.
Okay, that's a wrap from the a summary of what we covered off in our monthly conference call this month regarding energy. But I wanted to bring that to everybody just to say, it's hard to put that in a couple of tweets, but I think more importantly is just be aware of the big picture change that's going on behind us, and good luck with that. If you'd like help with investing in that whole movement, you could go to gregschnell.com/explore, and we have a package there for less than $10 a week that we could help walk you through that. Thanks again, and best wishes on your trading. Have a great fourth quarter.